La 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 la. So welcome to Forex.Today, everybody. Oh, gotta turn the camera on the face. Boom, 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 boom. All right. So hey, good morning, everybody. Welcome to Forex.Today. Let me remind you that trading is risky, not appropriate for everyone. Past performance, however, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Hi, my name is Wayne. Nice to meet you. I've been trading currencies for a very long time, very, very long time, since the beginning of time for retail Forex traders. So I'm here to answer questions, technical analysis. I love to use for entering trades, fundamental analysis. I love for creating strategies. Trader psychology, yes, I've looked into the abyss and wondered, is it worth it? So I've been there, been square. Let me know how it can help. I'm with TradersWay. We're a boutique brokerage firm, and we'd like to earn your loyalty and respect, and that's why I do these webinars every single day. And when you feel you have the skills, confidence to start trading real money, perhaps you'll choose TradersWay as your friendly neighborhood broker. Or should I say, friendly global broker? Yeah. So, namaste. Thank you for being a client. If you are, throw your diamonds in the sky. All right, cool. That got weird right there. All right, so let's get going. So it's a Tuesday, which is kind of like a Monday. I have to keep this webinar short. I have a crew of 15 people working on my house. It's a pretty amazing thing too. They're hanging all over the house on ropes like they're mountaineers. So it's kind of, they're good. What can I say? Good. Tristan says, hey Wayne, just wanted to thank you for all your help over the last few months. I've been averaging 100 pips a day for a good while now. Boom. So Tristan, did you put some money into the tip jar on Forex.Today? There's a whiskey and cigar fund that you can contribute to. Just saying, you got to share the love. Yeah, boom. Right? That's just how the world works, though, right? Oh, yeah. All right, so congratulations. I don't have 100 pips yet today. I only have, oh, damn. I've lost some profit. So I'm only at 40. It was closer to 100 recently. All right, so let's go through the chart. We'll go technically. Yo, yo, yo. Might as well start over here. Here. Big dog, pound dollar, kicking off the weekly R1. But the dangerous part of this is we've already blown through the monthly target. So everything, this whole move here, this is sort of you out on your own. It's a less desirable situation. Okay? And just in case you're not following me, this area here is supposed to be the high for January. Well, we're only halfway through January and we're above that. So it's now, be careful. I mean, it's less predictable. If I went back through, 100 months of pivot points, you would see that the vast majority of the time, we're not above or below the opposite, right? We're not beyond the predicted highs and lows. It does happen, but it's far less common, okay? So you gotta be, you gotta be a little careful, a little bit more short term, and just realize, I mean, that's all it is. If you just know that it's a little bit overbought, then you should be a little more cautious. Maybe manage your stops a little bit differently. Maybe when you're trying to make a decision, do I take profit here or not? Maybe the answer is, yeah, probably. or at least partially, or something, but at least you know, and you use that information to make a decision. Because if you don't know, then you're not a pro, yo. I just wrote that. That's on my t-shirt. Okay. So anyways, so you're up there, weekly R1. Seems to be helpful anyways, a little weekly R1. Okay. And yeah, aggressively moving. The interesting thing is it weak dollar? Well, that's what we've been talking about. We haven't really been talking about strong pound. We've talked about oversold pound sort of recovering. But I believe the story, as you know, from about November is more dollar weakness than anything. Right? In this case, it's a little bit of both pound strength and dollar weakness, but I think the bigger story to play out. Joe says, yeah, Ashraf Ladi. Yeah, I mean, and it's the same thing that I'm talking about. And by the way, Ashraf is a smart guy. So I like his analysis. He and I have met multiple times, spoke together on panels multiple times. So anyways, yeah, so I'm kind of talking the same thing. It's all about macroeconomics. In my analysis of macroeconomics says the dollar should be weak for like forever. Right? Until the Fed stops raising interest rates. When the Fed stops raising interest rates, the dollar will get strong. You've heard me say that 1,000 times over the last 12, 13, 14 years, right? So this really started back when the Fed started to taper, really. Okay, that's the change in policy that creates the change in currency. By the way, I'm supposed to be taking a microeconomics course this semester. I'm not into it. Microeconomics, like, I don't want to compute whether we should make 5 more units of production, based on our marginal utility of blah, blah, blah. How boring, right? And then I found that there's an intermediate class at Harvard on macroeconomics. By intermediate, they mean wicked difficult. And it uses calculus and stuff. I'm like, wow, I don't know calculus, but that sounds cool. Make my life so complicated enough. Doing research. And not only is he an award-winning professor at Harvard, he works at the Boston Fed. I'm like, oh! Learn macroeconomics by a PhD Harvard brat working at the Fed. I'm like, oh, I kind of want to do that. I don't want to do microeconomics. Here's the problem, though. I know the professor that does microeconomics, and I think I've taken his class 3 times now, different classes, and it got A's every time. So I know the process. I know the way. I know how he likes his homework. I know that I can anticipate the quizzes. I understand his grading system. I got it pegged right after 3 A's. I got this professor pegged. And I don't know this dude, and when you read his stuff, he's hardcore. He's it's gonna be difficult. It's gonna be challenging. I probably won't get an A. Could cost me the dean's list. So what do I do? Do I do the easy class, or do I go for the hard class? Yeah, but you give up the dean's list though, Ryan. You don't want to graduate with honors. You're like, wow, I did the honorable thing. I took the hard classes. And they're like, yeah, F you, we don't care. Yeah. So I'm thinking that too, but I have to petition the head of the department. Yeah, but I'm thinking the same thing you guys are. It's just punishment anyways. But right, learning macroeconomics from the Fed dude, right? I mean, it's cool, right? Yeah, it's a no-brainer. Yeah, thank you. I might be too late because classes start on Monday and I have to switch a class with department head approval. Yeah, micro. Jeez. That's for accountants, right? Yeah. All right, so yeah, we all think the same way. All right. CAD, nothing's really changed. Look, I drew these blue lines before we got there. So I'd say, look, it kind of seems like the blue line's held. Now we're back down. And then, I don't know. My general philosophy. A month ago, or maybe a little bit longer, we talked about commodity currency rallies, right? I think it was way back up in here, right, Johnny? But before all of that, right? We talked about just macroeconomics points to a recovery in commodities. Now, there might be some Chinese stockpiling at the end of the year and all that kind of stuff. Yeah. But I'm talking a little bit bigger than that. I'm talking about not what's happened over the last 10 years. Something new. And that's the bigger story, right? On everything. So one of the things we talked about in oil several weeks ago, we talked about the demand side as far as heating oil and refinery inventories and all that kind of stuff, right? But we also talked about something about a change in oil prices or the energy complex, if you remember that, where it's not necessarily just a story of supply, because it used to just be supply, right? A new rig count goes up, boom, oil prices fall, right? That kind of stuff. It was all supply because we didn't really have any demand globally. And then I said about, I think a month, 5 weeks ago, I don't know, that I think based on macroeconomics, there's going to be a demand side to this. We're going to look at increases in demand, not only supply. It was funny because if you go back 10, 15 years ago, it was all demand side and it wasn't a supply issue. So it flipped, and now it's a little bit of both. What are oil inventories going to do? Where is demand coming? And remember, not demand today, sort of demand in the future. But then there's a hiccup in between. A refinery has enough oil for a week, maybe. So if there's a hiccup in the supply chain, then that's the tertiary issue that can move oil prices, right? Like a hurricane goes in the Gulf of Mexico and shuts down all the rigs, 3,000 oil rigs. Okay, now that's an issue above and beyond just normal supply and demand dynamics, right? We're not talking about an equilibrium curve, right, price. We're talking about a shift in a supply curve or something, right? So anyways, I think demand is going to go up, but at the same time, we're going to start stockpiling. And do you know why I know that? Why are inventories going to go up and up and up, not just 7 days, but more and 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 more? Because it always happens! See? That's why it's good to be experienced, because it happens every year. So, right, seasonality. We talk about peak oil happening June 1st and all this kind of stuff, right? Yeah, at this time, every year, since the seas parted, right? What seas? I don't know, the Red Sea, the Dead Sea. So anyways, forever. It's always been that way. So that's all we need to know. And it has to do with the summer driving season. Demand goes up in the summer, so that we need to start preparing for that. So you might see oil prices go up, and you might see inventories go up. But we haven't been watching that happen in the last 5 years, the last 8 years, right? And, you know, regardless of price, well, we're going to see. But if you go all the way back to 40, remember how we predicted that was the bottom, and that there was another buying at 45, and then there was another buying bottom at 50. Remember, had the whole 50 to 60 thing and 45 to 55 thing? I mean, it took us months to go through the 45 to 55 cycle, but we talked about that being the bottom. And I think part of that's still there. I think it's going to go up. I think there's going to be fracking problems, right? I think so. Supply will come in, and so on and so forth. But demand will be picking up as well. For, you know, and there'll be instead of separateness, there'll be some sort of togetherness. I don't know what that means, but prices may be uppish, flattish. Okay. And then what happens June 1st? And thank you, Ryan. Wait, it's not summer in South Africa. What are you talking about? Summer driving season, and demand goes up. Thank you. Right, exactly right. So demand goes up. So here we are now casually. Are you understanding? We're now predicting months and months and months in the future. You know, I know you like when I do this, right? Oil inventories are going to go up, and then demand will go up. While all that's happening, while we're building inventories, global demand should also increase, or at least the expectation, but not too much. So, like India's going to like really expand. China's not going to expand as much, or I guess we should talk about production, right? Production in China will be much higher than the United States, but not as much as people think, because they're stupid and they think 10 years ago and they want to apply it now. China today is not China 10 years ago. China today is not China 5 years ago. So you can't have the same expectations, right? 7% growth. What? Have you been to China? It doesn't look like a third world country, right? I mean, at some point you can't expand at 7%. At some point, you're not going to find a guy to work in a factory 9 hours a day for a nickel, right? So anyways, there'll be demand. It's a good thing, because we may be in some economies we've lacked it for a while. So I don't think down, I think more up, but we got to be cautious and careful and all that kind of stuff, right? And then adjust as we go along. Because I think China will slow down. I think India will pick up. Will they offset each other? Maybe, right? Remember, India is going to win. We talk about China today. China. India is going to win. The whole entire world is going to look like India in 100 years. It's democratic. Somehow it works. It's chaotic, democratic, but it works. You'll see. No, oh yeah, no. Trust me, it's going to happen. What's going to happen first, I think, in the Western world, or in the developed world, or whatever the proper language is, the OECD countries, their social welfare programs are going to run out of money. And that'll be that. Yeah, be like, well, Portugal, they're putting old people into schools because there's no children. Japan sells more adult diapers than child diapers, all that kind of stuff. Yeah, we're on our way, guys. But anyways, just another reason to get filthy, stinking rich. So, right? We need to deal with better problems than global poverty. You should be arguing with your neighbor over who has the better movie theater seats. Yeah, so anyway, so that's moving. And we talked about that CAD strengthening on oil up in here. So that's happened. We're not at a good place now to sell. You had a chance at the higher end. We're a little more supportive, and you can see if we do break the support level, it would be down here, but now we're talking February, if at all. So 60 seems all right with oil. I think we were talking 63, 64 a week ago. I mean, we could look at oil now. But, you know, this is not nearly as bullish as it used to be, right? So it feels like we're tiptoeing into consolidation, right? If you were a cheeky monkey, you would be selling this. Very, very obvious sell. The only problem with it is you're selling in an uptrend, so it may not last. So your target might be more conservative than other scenarios, right? Right? Like you might just target this area here. Okay? And just play because that's where bulls are. The bulls are down in here. So you might just say, well, I'll take this for a little trip down to 63, 62 and a half. Call it a day. Just as we have half the people earning the minimum wage, blah, 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 blah. Yeah, well, then you need to take care of yourself because, as we can see, no one else is going to take care of you. We're all on our own, and the system's broke. So you need to start hoarding. And I don't mean stacks of firewood. You need to own things. In America, it's about what you own. If you own things, you're wealthy. And you don't have to work. And you'll find that your trading will mature over time. When you first start, at least, how about this? I'll use myself as a guinea pig. When I first started, I traded day, night, night and day, night, night and day. Scalp, spot. Just, and it's a way to get rich in the sense that it's hard work, and it's never ending, and it's very stressful, and but you can make a lot of money, so you're rich. But as soon as you stop working, you stop making money. That's what happens to rich people, right? They're rich, and then they lose their job, and they're like, oh, I'm right. Wealthy people don't work. And so in my beautiful, see how silver my hair is now? In my beautiful silver years, I try to make my money work for me as much as possible. And that's a general idea of of everything. So the American dream used to be to own a house, right? Now it's to own 8 houses. And then taxes have changed in the United States. There's less incentive to buy a house now in places like California and New York where it's super expensive. So people won't buy houses, and what will happen is they'll rent. So those that own, so we're going to go right back to the thing where Karl Marx was against, for example. What did Karl Marx hate? One of the most evil things in the world, according to Karl Marx, was rent. Because it becomes a trap. You can never buy because you rent, and because you rent, you don't have any money, and because you don't have any money, you can't buy. So therefore, like my friend, he bought 8 houses in the last 5 years, right? He'll own all these houses. and he'll rent them out. And his only job is to collect rent. That's his job. Right? Oh, please, sir, we don't have money for the rent this month. Right? Oh, gotta break your legs. Right? I mean, so, yeah, don't F you, where's my money? Right? So, but that's where it could lead. You know, it's kind of interesting. So, if you want to learn from history, the last, I won't go back to dark ages, although I've studied economics of dark ages. You know, I don't know, since 1700, 1600s even. You need to own something, and back then it was just real estate and factories, but now you can own stock and you can own other things, but it should appreciate and it should pay you an income. Trading should represent that as well, and I'm trying to show you the bigger trades, because the skippy scalpy stuff is easy, but it's just relentless as well. So like, do you remember talking very clearly? You know, we were timing it to the day. This had rallied, and this peso had rallied, and we're like, okay, wait for it. Now start selling. They're gonna just keep going. It's been what, 18, 19 days, 19 days, right? Bigger picture stuff, though, right? I mean, we're talking about increases in supply of oil over the next 6 months, and then a shocking increase in demand. And you know, what will that do for oil prices, and who will benefit, and how can we put this into play every day, so over the next 6 to 12 months we can make the right trades? Who in their right mind would talk about shorting this? And not here, and not here. These are all resistance, right? Not here. Not at the top, not here, not here, not here, not here, not here, not here, not here. And then up here, well, we're a bit early, maybe wait a day. Okay, well, now we're in here, now's the time. Boom! Right? 19 days of winning. So put that, like, when you're a scalper, you make 19 trades in 10 hours, 20 trades in 10 hours. It's a lot of work per day versus just one trade that lasts 19 days in a row. Big difference, right? But that's the wealth effect. And then over time, what you'll want to do is you'll want to combine that. Because look at this. If you remember, there was a short here, down, up, sell. But that's not on the 4-hour chart. That was on like a 15-minute chart. And then there was more of a macro one here, which was on like an hour chart. So that's 2 trades in here. Look at this, down, up, sell. See the roll reversal? See this wick over that bottom? There's another one, down, up. See that wick? Bring it across. There's a new sell. Down, up. No real sell there. Down, up. Into the moving average, into the pivot roll reversal. Down, right? Some consolidation. And finally a breakout, breakthrough. There's a lot of trades here. Down, up. Do you see this one? Up, roll reversal, immediately fell. Rinse and repeat. So all I'm saying is there's some nice stuff. There's some nice trading. It's ideal to start with a macro vision, right? So peso's just loving it. Okay. Turkish lira, I wanted to sell this. I almost did. I was looking to do it yesterday, and I didn't have the setup. And when I looked at it, I don't know if this happened yet or not. It must have, right? But I wasn't quite ready, although I didn't see this. No, so I must have looked before this pop. So now it's popped and dropped. And then when I did see it this morning when I woke up, I'm like, well, I can't. Come on, Baba. I can't sell it here. I think we were right there, right? So now I got to kind of wait down, rally, drop. But nice that we drew this ahead of time though, huh? Is that pretty? We drew this quite some time ago. Remember, I took my profit in here. Remember, before it became an inverse head and shoulders? So then we drew this. And went back down. And look how awesome. It's not a 50% retracement. It's not a 618 retracement. It's the monthly central pivot. And by the way, to the pip. Could be random though, right? Could be random. What an amazing coincidence. So it might be time to tiptoe into this. Wouldn't it be cool to have a personal goal that this year in your business plan, because I know you had a business planning retreat with yourself at the end of the year, like we talked about, right? Wouldn't it be interesting to say you would like to hold 1 billion lira? Challenge yourself to see if you can do it. 1 billion lira. 10,000 US dollars at a time. Slowly, slowly, slowly. Oh yeah. That's an expensive dinner, Chuck. I would really love to go to Turkey. Everyone that I know that has lived in Turkey loves Turkey. I've always wanted to sail around the Bosphorus Straits and such, and I almost had an opportunity to go there about 6 or 7 months ago. So I'm like, hey, got to stay at the Ritz-Carlton. I'm a gold level guy, so I'm like, always stay at Ritz. So check it out. And we have this hotel room with the view of the water below, of course, right? With a patio. Like a patio for 25 or 30 guests can hang out. There's a bar, there's a hot tub, there's seating areas for the hotel room, right? I'm like, what? I could sit outside, smoke a cigar, I could have a bunch of people over, it's great. And it was like 300 US dollars. Nothing. I'm like, oh my God, I gotta go. I gotta go. Right? I mean, come on. Right? Oh my God. Turkey. Gotta go. Love that lira. Whoop, whoop. Yeah, but that's what I'm saying, right, Robert? Wouldn't that be great? Let's go. Let's all meet up in Istanbul, Constantinople, Istanbul, right? Cigars and wings patio, club level. So anyways, love that lira, and it pays the best. So CAD, All right, let's move over to the yen. We had a pullback in some of these yens, so my floating profit and loss for the day has diminished. Yeah. So I shorted euro yen at the weekly M3. That's weird. Who does that? Now, I don't like shorting euro, so you should know that, and I might pay the penalty. But at least you see what I did, right? Just a boring swing. It was overbought at weekly M3. So I shorted, right? Like, so now it's whether I can hang on or not. And I would probably guess not. I think it's going to come up and knock me out at break even or something. I don't feel too lucky on it, but I did my job, I guess is more like it, right? So, you know, any swing trader knows that that's just a straight up boring textbook cookie cutter, nothing even interesting about it setup. I did the same on the pound around the monthly M3, but I don't feel good about that one either. It was late, that kind of thing. It's a 50% of the actual move, so I think it could totally 618 and drop me around. So what I might do, let's do it this way, just to be cheeky about it. Why don't I move my stop now to break even? And then you could add one here. Off the top. Top. You got it? Questions? Nope. Great. Go. So that's Beast. You got to be careful with Beast. You got to be careful. I don't like to say, well, I'll just have this stop 70 pips away. It'll be enough. Because you know what it does? It comes up 70 pips, hits your stop for a loss, and then drops, just like you said. It's evil. No, it's evil if your trading sucks. That entry is pathetic, so why would I take the risk on a pathetic entry? If it was an awesome entry, you know, I'd feel more confident in it. It's pretty mediocre. There's nothing there to hold price down, so I'm not taking risk. I'm managing my risk, right? So we did euro, we did pound. Someone asked about Aussie. Here's my Aussie. I got to zoom in here. I sold one where we are. Okay, so I guess I got to really drop into a 15 to take a look at this. I sold at the weekly central monthly M3. And I still have one from last week, if you recall. I took this one where it went up, right, and I caught it on the way down. And it was fine for a while, and then it didn't end well. So, anyways, I'm trying here. I'm trying. These moving averages are supposed to hold it down. So in let me calculate this. In 45 to 60 minutes, it should turn around. Okay. So I got my stops just above these areas. Come on, let's do it this way, just so you can see. Okay. See what I'm doing? I'm just around here. What I'm hoping for, if you want sort of the bigger picture, I'd love for this to come all the way down, double bottom here, and then up. Ryan says, so at the stock market open, or something like that, but I was just calculating based on what the stochastics told me. So, yeah, but that could mean it could spike and then drop, right? So, don't really know. But I'm trying to keep above these, you know, lovely humps, as Fergie would call them. Kiwi had a great setup, and I wasn't there at the right time. So now I have to make the decision now that this low is lower than this low, right? So let's draw this differently. Okay. And this high to this low, the important part is it's lower than this low. Okay? So the thought process now is it's going to do something like this. Okay? I'll highlight the move by this, up into the pivots, into the roll reversal, extending down to the next pivot. So it's a Fibonacci of this move too, right? Okay. The danger to this plan is it doesn't seem like we've made a really good breakout. So this could just be consolidation, right? And you can see I have it consolidating down in here anyway, so this might just be down into here and then back up. It might just be a dog with fleas, we don't really know. But it shows you if you happen to be a bull on Kiwi and you happen to be a bull on yen, difficult trade to make, you probably have something better to trade, right? And then if you ever turn the other way and say, well, I'm still a bull on Kiwi, but I'm a bear on yen, then you're probably going to be buying, buying at some sort of support here someday. Right? So this is looking at it on a 15-minute chart. Do you remember what we talked about? Can't even do it on the, let's try a 1-hour chart. We were talking, what? November, December, we were talking about a yen pair rally, right? Right? This is where you have to type. We were talking about an end of the year yen pair rally. Yes or no? Lots of yeses. Okay, good. Now I'm going to start asking questions instead of yes or no. You're going to have to try to answer this. Up, or I guess it's still it's not yes or no, it's up or down. Up or down, which direction did we expect yen pairs to move at the beginning of 2018? The answer is down. Down, 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 down. All yen pairs down. Which week did we expect to see a false rally in said yen pairs? Third week. So that's now, right? So isn't it interesting? So like this is pound yen. Isn't it interesting that at the beginning of the year it crashed? And what, the day before, the day before the third week, we had a significant rally. So I'm a day off. And it happened on all the yen pairs, by the way. This is the one I happened to grab. Don't even know why I grabbed this one, but there it is. Interesting, right? Now, is it over and all that kind of stuff? I don't know. But I sold at pivot points. But I'm not a believer in the rally. Well, no, but it shouldn't have dared. Remember, I'm not even looking at that pair because I'm bearish on both, generally speaking. So I would never, someone I'm looking at. Yeah, wow. So, this is it. I'd rather be long than short this pair, but right now, we said this week we would possibly see a false rally off of the drop. This might be the false rally, especially with the lower low setup, right? So maybe, just maybe, it's happening, but this could still be the false rally scenario. This could rally up and maybe even make a higher high. I hope not, right? And then we go back to yen strength. Maybe. I mean, we don't know. There's a lot of moving pieces here, but there's a lot of amazing coincidences, right? That at the end of the year, well, it actually started in September. Now I got to go to a 4-hour. This is third week of August, right? Right? That's when we talk months and months and months and months and months in advance that the third week of August we're going to look for a rally. Is that a fact? Or am I even in the slightest making that up? Fact. Great. So it rallied up. Then we're hoping for a year-end rally and then a significant decline. These are all months in advance. Here's the year-end rally. Here's the year open drop. A third week rally. So far, so good. But again, I don't know if this wants to make a higher high. Remember, I'm not in control. I've just experienced, right? So this could come up and then back around, or that is the third week rally, and then we work our way down. Okay? Okay? So, just very interesting coincidences, right? But now you'll see why I'm shorting this rally. It's only because we talked about it 6, 7, 8 months ago that this would happen and it would be false. So they're not great setups. I haven't swallowed the hook, but I should take the shot, right? So. Well, be careful, Ryan. Your logic is probably fine. I didn't read it to the great detail. But you got to be careful. And I see this a lot with like analysts on TV. They're taking like mechanical pieces and they're like, this has to do this, right? The most important way to look at it, or to start your analysis, in my opinion, is not the pieces, it's the reason, right? So why would a portfolio manager dump their stock portfolio that they've spent the last 10 years building? You got to answer that first, because it's not even their money, right? So they don't care if they're 5% decline. They're going to call their clients and say, don't worry about it, ride it out. It's just market timing. This is normal. We had this planned out. Just please don't take your money out of my fund, right? So you got to have that catalyst first and foremost. And then all those pieces kick in. Okay? So I think fundamentally, I think the most important thing that's happened recently, and I talked about it to the day, I think it was last Monday, whatever kind of needed to happen in the bond market kind of happened. And now, in a little bit in hindsight, we're now sort of 2 years into a bearish bond market, right? Because interest rates we're below 2%. Now we're above 2.5%. It's probably been 2 years since we're at like 1.7. Now we're on our way to 2.7. That's a big change, right? And the market is not manipulated like it used to be by the Fed. Global macroeconomics also dictate that maybe other governments are not buying as many treasuries as they used to. There's less fear in the market, so then there's just a lot less demand, right? Which means there's more cash, and then that cash goes where? They buy some more stock. So you got to be careful that we don't end up being the guy that said, well, look at all the facts, stop buying internet stock in 1994 because it's overpriced. Stop buying the internet stocks in 95 because they're overpriced. Or at 96, stop buying them. Or in 97, stop. Like, because those pieces are there. And then finally, in 2000, it comes crashing down. They're like, see? But you're like, but dude, you've been shorting the rally for 8 years, right? So all those pieces are correct, I think. I mean, again, I didn't go through every detail, but you got to stay psychology first, right? People are making money, and they're going to keep making money until they all realize they're standing on their tippy toes on the edge of a cliff, right? And then, whoa, you got to switch, right? Are we at the precipice? No. I think there'll be some hiccups along the way, which are necessary. But, you know, so like I'm talking to this construction crew that's doing work on my house, and I'm asking them questions. I'm an economist, right? I'm asking them questions. So, you know, how's business? We're stacked 3 projects at a time for the foreseeable future. Well, what are they, you know, what else are they doing on their houses? And he's talking about this, that, and the other thing. Everyone's doing stuff. So I said, well, is it just, big houses like mine, or is it all income levels? He's like, everybody. He's like, a whole bunch of people bought houses, when prices were low and during the crash. But now their jobs are good, credit's available, money's cheap. Now they're putting money into the house, and boom. And he's like, you can't get framers, you can't get tile guys, you can't get painters. And I can confirm that. I had people come out and budget these projects for me, or put proposals for these projects for me 5 years ago, and the prices have nearly doubled. Because 5 years ago, there was no work for these guys, and so they'll do it almost at cost. Now they're like, you got to pay a premium for me to come out here, coffer your ceilings. Wow, gee, you know. So everything's great here, right? Right? Everything's great here. Everybody's filthy, stinking rich, according to my construction crew, according to the lead guy, right? Not to the guy that talking, the old white guy on TV, right? Blah 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 blah. I went to Princeton. I know lots about money. No, I'm talking about the Hispanic guy that's managing the crew. His point of view, things are great. So that will keep happening. Why? Because people are spending money. That construction crew, and then everyone on his crew's making money, and they're out spending, and they're investing, and all of a sudden they're buying houses too. It's trickled down. 6 or 7 years ago, when we were talking, I said, in particular, it was to the euro. I said, wait until the average Juan sees the money. You guys remember that? In America, it was the average Joe that trickled down of monetary policy. Right? I said the guy that drives a forklift in a warehouse, when he's driving a Cadillac Escalade and he has a 70-inch TV in his apartment, boom, right? That's your litmus test. And I said, and then it was Europe's turn. I said, wait till you see signs that the average Juan is doing good, not the average Joe. And I think we're getting closer to that, right? Yeah, the beast is right. He says, hey, he'll raise his prices when he has more. Yeah, but that's what I'm saying. That's where America is right now. I can't get a framer to just hammer 2x4s. And put, that guy's too busy. Which means they're driving new trucks. You know what I mean? Price is 2,000 a year. No, I think that's going to drag, and then maybe pop later. And that'll be the story down the road. So I wouldn't say inflation yet, because we're still, I still think we're in a normalization. But the most important thing isn't America. It's the rest of the globe. Right? This is what I think about. I was in Shenzhen, I don't know, 2-3 years ago, and I'm sitting in my bathtub looking out over the glass wall. There's a beautiful park down below and stuff, and there I am in Shenzhen, China, sitting in my bubble bath, looking out the window, down at the people below, and this is what I'm thinking, how does Shenzhen feel? When Shenzhen is booming, that's important, right? Johannesburg, what does Johannesburg look like? Or Paris, or London, Hong Kong, Dubai. I've been to all these places in the last 2 years. And I talk to people, I talk to cabbies, and I look around and I pay attention. And I look at prices and how things are changing, and it's cool. I mean, that's the best part of being a currency trader, right? Travel. Look at Singapore. Singapore is awesome. How is Singapore doing? Where's the money going, right? That's a lot of countries to visit in 2 years. So oil is getting up, so things get more expensive. Yeah. So this is so here's going back into economics now. Inflation's going to go up, right? So we can look at this. When oil goes up, you'll get inflation. So then you got to say, well, how much of that is oil prices? Remember where the world had no inflation. ECB was getting crushed. Remember I was talking about this? We have to go back now 3-4 years? I don't know. You and I, 3 or 4 years ago, were talking about poor Draghi, right? Doing quantitative easing, and oil prices were at $40 a barrel, right? Oil prices had dropped 50%, which is deflationary, and yet Draghi is trying to create inflation. Worst nightmare ever. Suddenly we're going to see inflation again. Why? Because we went from $35 a barrel to $65 a barrel. That's going to create inflation. So now an economist has to do a couple of things. What about core inflation? Do we really have wage growth and increase in consumption from better jobs? So you have to strip away energy prices now. You didn't have to do that before. We would say the opposite. And it was really weird. You may never see this again, but a couple of years ago, we were looking at things like core was lower, core was higher than headline inflation. It was weird. Core was higher than headline. It's supposed to be the other way around, right? There was all these inversions and backwardations, and I don't know what you want to call it, but strange topsy-turvy world. Brent was priced at the same as WTI. These things don't exist in the normal world. So now we're getting back to normalization. So now we say, well, okay, we're starting to see inflation in Europe. We're starting to see some inflation in the United States, for argument, right? And then you strip out the rally, the $30 rally in oil, and then all of a sudden you're like, whoa, you don't have inflation again. Well, that's why we do this. And then what about real inflation? Or, right? So now you have to take inflation and then subtract current prices, right? You have to index it off of a previous year, right? Based on 2005 prices, how much have things gone up, right? How much of it is just a change in currency, that kind of stuff, right? So, right? So you can start measuring in different ways. And it's really important to economists to find out what the truth is. And once you know that, then you can start making better decisions fundamentally. Right? For example, how much of it is just dollar weakness? Right? How much of CPI is simply dollar weakness? You need more dollars to buy the same basket. How much of it is an increase in demand and consumption? Is it falling dollar or rising prices? That's important, right? Because they're opposite. One's good, one's bad. So is CPI going up because of a rise in prices or in a fall in the dollar? Is inflation up simply because you have to pay more gas to put in your car to drive your stupid lame job in middle marketing where you sit in a cube all day like a factory worker putting labels on cans? You have to pay more to drive to that job? Well, that's not a good thing. Right? Or is there inflation because you got to pay a guy to hammer nails into 2x4 and you have to pay him 50% more than you did 5 years ago? Well, that's good for him. But that might be a good thing. He's working, he's busy. So that's why in economics that we try to split the numbers up, because the numbers are not even half the story. Right? Right, Jim Dandy? So cool. So we got things, Oscar Mike. Maybe it'll be an all right start. So Robert wants to know about purchasing power parity, really. There's something called the Big Mac Index. What does a Big Mac cost in Tokyo versus India, right? So versus Indiana versus Turkey, right? So you can look at a simple thing. A Big Mac in Istanbul versus a Big Mac in Mumbai versus a Big Mac in Tokyo versus a Big Mac in Hong Kong versus a Big Mac in New York City versus a Big Mac in Atlanta, Georgia versus a Big Mac, all this kind of stuff. Because a Big Mac should be roughly the same, wouldn't it? It's commoditized. And in South Africa, Big Mac might be $1 in dollar terms, but might be $7 in dollar terms in Tokyo. Might be $5 in New York City. Sure, but it's still commoditized. It's only a luxury in India because they're poor, so that's the whole point. Yeah, don't count the airports, right? But so purchasing power parity type things, PPP as it's called, might help you make a decision. Where do you build your factory? China or India or Malaysia? Yeah. Erica wants to know about VIX. Well, do you know what VIX is, Erica? I don't know what you asked my thoughts. It's pretty open-ended question. Do you know what VIX is? There you go, Ross. Look at the Economist, the magazine. They do the Big Mac index. So look at purchasing power parity and the Big Mac index. Okay, risk premium. Okay, so there are those that trade the S&P 500. To protect themselves from losing money, let's say, they use options to protect them on the downside. Options are great for hedging. They're designed for hedging because for a little bit of money, you can protect a big position, and you don't even really have to manage the option, because if you did your first job right, buying the future contract, and it goes up, well, you bought an insurance policy basically for a few bucks. It's nothing. You buy, and if you don't need it, it just expires worthless. If the stock market falls, you make money, and then so the money you made on the option offsets the money you lost in the futures, right? So you have an options market and a futures market. And by the way, I've been in the pit. Yes, let me change this. The S&P 500 pit, trading pit in the Chicago Board of Trade. Here it is. Okay, that's me, Chicago Board of Trade. So there's a pit here, and just on the other side of it, if you couldn't actually see it, but just towards this big board, between that big board and where I'm standing, is a second smaller pit. Second smaller pit. And it's the S&P 500 options. So these guys are trading futures. The ones behind me are trading futures. Behind them are options, okay? So what happens is, if you're not sure about your trade, so you bought S&P 500 futures because you believe the S&P 500 is going up. If you're confident in that, then you bought it and you're fine. But if you're not entirely sure, you're like, you know what? I'm going to buy some insurance. I'm going to buy an option on the S&P 500 downside. So if the S&P 500 falls, I'll lose money in my cash futures market, but I'll make up some or most of the money on my option. But I probably won't need it. The stock market will probably go up. The S&P 500 probably go up. I'll probably make money, right? So it doesn't cost me much to buy the insurance, aka the actual option. It's not insurance, it's an option. Well, what if you're so confident that your S&P 500 futures contract is going to make money that you don't even buy a piddly little option that costs you hardly anything? But what if you just thought that would be a waste of money? Well, then you're super confident, maybe irrationally confident, okay? But what if it's the entire market? What if, generally speaking, nobody on the S&P 500 is buying insurance to protect them from the downside risk? Well, that's what the VIX measures. It's called a fear index. So they're looking at the amount of insurance, if you will, purchased through the options for the S&P 500 specifically, right? And when the VIX is low, virtually nobody is buying insurance, which means they're confident. Well, it may mean the stock market's going to go up and up and up, but you might get to a point where there's so little insurance that if the market does dip, everyone's going to get out quickly. Everyone's going to just freak out because they're losing money. If you had the option, the insurance, right, then you wouldn't be losing money. You're just making it up on the option. You're like, I don't need to panic here. But if the whole market is naked, if you will, naked, they're long the S&P 500 futures contract, and they have no option, no insurance, no nothing, they're long and strong, but they're naked, which means they're going to suffer the pullback, okay? So a low VIX means nobody's buying, or very few people are buying insurance, and it may point to a market that's overly confident. So now if you're watching the S&P 500 and you're also using technical analysis, and you see you're at like a monthly reversal pivot point and stuff, and VIX is very, very low, it may point to the fact that that could or very likely will be a top, at least on some time frame, right? And the market will crash further. So a low VIX for long periods of time shows that there's low volatility, lots of confidence in the stock market going up, and the market is generally naked. So that's why, on top of that, you should add technical analysis. So it's almost like a sentiment. They call it a fear indicator, right? So it's kind of sentiment. If VIX is low, there's no fear in the market. That might not be healthy. If VIX is high, market is very, very scared. There's lots going on here. So Ryan is 11, right? So yeah, so typically if it's like 9 or 8 or 7 or 6, those are really low numbers. Shooting up to 11 means people are, right, let's say it went from 9 to 11, people are starting to buy options to protect them from the downside. Well, I would I think, Katie, if you were in a stock market rally that was, in your measure of technical analysis, overbought, and you were at resistance, and then you looked at VIX and it was very low, it would just tell you that the market is overly confident, and if it gets held up by this resistance, lots of people are going to bail very quickly. So it might help you form the opinion that a top in that market is starting to form. And if you're a portfolio manager, maybe you should take some profit, and, that kind of stuff, and just thin the herd a little bit, rebalance your portfolio a little bit, but it points to a risk. Okay? You just Google it, Chuck. It's on the internet. Cool. It's probably more detail than you needed. Looks like I'm out of time, so I will see you tomorrow. So yeah, you can Google VIX, you can Google purchasing power parity, Big Mac index, PPP. Oh, I didn't do that, Katie? Really? Huh, my bad. Well, peace on earth. May the pips be with you. May your profits be above average. Yeah, Kenny, absolutely. Thank you for being on my team. Thank you for your loyalty every single day. Thank you for being a client. And if you haven't done so, please visit TradersWay.com and open up a demo account and let us earn your loyalty and respect, and hopefully you become a part of our family here at Traders Way. And for those that are starting to find some success, congratulations, you earned it. Oh yeah, and if you were here yesterday, I'm like, dude, you guys need to, the stock market was closed in the United States. If the stock markets are closed, if the banks are closed, I don't trade. Never have, never will. Yeah. Bond market's closed. Just don't trade. Yeah, don't trade those days, yo. Okay? And if you didn't know that, you need to put it on your calendar to know these things. Yeah. No, but it's an important thing. I'm not being facetious here. Yeah, you need to know these things. Like, when does the market stop trading? It's just something that Because if you didn't know, then you're not part of the market. You're an observer, right? Right? You know what I mean? So if you want to be part of the market, you need to be part of the market. You need to know these things. When are the banks closed? When are the bond markets closed? You know, all that kind of stuff. I'm not saying you have to know that it's Martin Luther King Day, right? You just need to know when the markets are closed. Right? Right? I don't care. Maybe you're Jewish and you're like, I don't know Christmas. I don't know what day Christmas is. Great. I'm not saying as a Jew you should know Christmas. But you should know when the market's closed. You're a trader. I don't care where you live, your creed, your race, your religion, all this stuff. Is like, if you're a trader, you need to know when traders are not trading. Right? So when the entire bond markets are closed in the largest economy in the world, when the entire stock market is closed in the largest market in the world, when all the banks are, I mean, what we do is basically trading between banks. So when all the banks are closed in the largest economy in the world, you kind of need to know, is all I'm pointing out. So it should just be like, if you didn't know, then you're like, wow, okay, now, right? Now you've been informed, and now you're like, why didn't I know these things? Right? So it's just an invitation to like, oh, you know, cool, wake up call, that's all. Right? Yeah, don't get verklempt, Mike. So anyways, namaste. See you tomorrow. Thank you.